Okay, so S corporations, chapter 22. S corporations have characteristics of both C corporations and partnerships. They offer the legal protection of a C corp. They have the same exact rules for formation and liquidation as C corps. So keep that in mind. You learn the C corp rules, you're sort of learning the S corp rules at the same time. And at the same time, having said that, they're a flow through entity just like a partnership. So let's get into who could be an S corp, how does it work, and then we'll talk some of the specifics. Okay, remember that the requirements are that there's a limitation on shareholders, only 100. Now, family members and their estates count as one shareholder, so at some level, you can have more than 100 shareholders, but you get the idea. There's a limited amount. Publicly traded companies, for instance, can't be S corps. Only U.S. citizens or residents, not non-resident aliens or something. Um, no corporate or partnership shareholders. So the shares can only be held by individuals, estates, some trusts, most trusts now, and even some charities, but you can't have a corporate owner or a partnership. It's a domestic corp, it's got to be domestic, and only could have one class of stock, and that's really critical. You can't have preferred stock, you can't treat people differently with the stock. Everything's got to be equal. If somebody that owns equity is treated differently than someone else, that sure looks like preferred stock and have a problem. Okay, so when you make the election, you make it within the first 2.5 months of the given year in which you want the election to be effective. You have to meet the requirements every day of that year, and you have to have everybody agree to it. Why? Because you're going to take on some flow through debt requirements. So you have to have everybody on board. Okay, so what's the voluntary termination? Well, you only need 50% to or greater to terminate it. If it's made within the first 2.5 months of the year, you can make it effective as of the beginning of the year. If not, you can make it you make it effective with the next start of the year. Although here's the thing: at any given time, you can have an involuntary termination, which is simply said somebody can just say, you know what, I'm sick of this S corp. I'm going to take one of my shares and transfer it to a partnership. They're done. Everybody loses their S election, and it goes back to being a C corp. If that happens, if you involuntarily or voluntarily terminate, you have to wait 5 years before you can reelect. Quite a long time. Okay, S corps can pick most methods of accounting: cash, hybrid, or accrual. They're generally calendar year end unless you can establish a business purpose. Profit and loss. This one's really critical. Always has to be allocated pro rata, per share per day. And then the question is, well, what happens if somebody sells shares during the middle of the year? And that is, well, we could do a daily allocation, or we can do kind of like a cutting off of the books, depending on different rules. But in general, you just need at your level for what we're learning that either one could be available depending on the circumstances. Again, just like partnerships, they have separately stated K1s, and it's the same K1 items, except the guaranteed payment doesn't exist. Everything else is the same between a partnership and an S corp. What else is the same? Well, if you look here, the way you calculate the basis on the contributions are the same as C corps. So again, like I said, once you learn the rules in the C corp chapters, you're learning the rules here as well. Okay, so here's the thing: if an S corporation functions like a flow through entity, we have to do the same thing with tracking basis on the outside. But unlike a partnership that combines the debt and the stock or the equity holding into one number, partnerships do make a distinct difference and keep the debt basis separate from the equity basis, or what we call stock basis. So what we want to look now is we want to look and see what these adjustments look like, and how they adjust. These adjustments only are going to go to the equity, right? So the contribution to the S corp, that's an equity adjustment. Ordinary business income and loss, separately stated, originally goes to the equity. Subtract distributions, non-deductible expenses. See, it's the exact same order. Although I will say that in the S corp scenario, they do give them the election to reverse these two, the non-deductibles and the deductibles. Just so you're aware, you could reorder those, and in practice everybody does that, right? Because you'd rather take your deductibles before your non-deductibles. Basis cannot be reduced below zero. That's a key component, just like on the others. and basis does not include your share of S corp debt. Why is that? Well, that's because your share of debt is its own separate limitation. Okay. Now, a couple things. Number one, what is S corp qualifying debt? Well, it's not what you think. Maybe it's not like the partnership, where the partnership allocates all of its debt out to the partners. The only debt that an S corp shareholder gets credit for is debt that they've loaned in themselves. They don't even get debt that they've guaranteed, like with like an obligation, recourse obligation. They've got to loan the money in themselves. And why is that? Well, because again, an S corp is not an aggregate entity problem. It's just an entity. So they say you're not going to get your share of the part of the S corp debt. You'll just get credit for basis for loans that you make directly. So what happens? Well, when you have a loss, you go in a certain order. You use all of your stock basis, and then what? Do you suspend the losses? Well, no. If you have debt basis, you're allowed to then go over after you've exhausted your stock basis to zero and reduce your debt basis down to zero. Once you've exhausted both of those, then any losses in excess of those two combined, so you're at zero both for basis, with those losses would then suspend and roll to the next year, looking for future years when you have basis to take those losses. In later years, though, when you actually have income and you're restoring or you're putting back basis to your debt and stock, you do your stock first. And this is kind of important because here's the thing. If you have debt basis with zero basis and you repay that note, you're going to trip gain because essentially the debt's going away. Okay, so then the rules work the same. You got at risk, you got passive, but you can see here that in an S corp, if you only get credit for the debt you've loaned in yourself, the tax basis and the at risk limitation, they're going to be the same because there's no difference. You're not picking up the additional debt like non-recourse you would for a partnership. Passive activity loss limitation, same concept. You got to materially participate. You look at the regs, you decide what that looks like, and you're looking for PIGs, disposal of the activity, take the loss, all the same rules. Post-termination transition period, it just says that after your year ends and you become a C corp, you get rid of your S election, you have up to a year to generate basis if you were otherwise suspended to take those losses. So you could make a cash contribution to the corporation, even though it's now a C corp, and still free those up. It just gives you the ability to come in and out to make it work. Okay, example: Nicole's basis stock was 14. During the year, she loaned 8. So total, if this were a partnership, you'd say, oh, she's got outside basis of 22. But in an S corp, we keep them separate: 14,000 and 8. Okay, so there's a $60,000 ordinary business loss and no separately stated items. She gets her cut of that. She gets $20,000 is allocated her, so she's a third partner. How does that impact her? Well, if you can see, first you reduce the equity in her stock to zero. Then you go over to the debt basis and reduce that down. Well, now she still had 8,000 to start with, so she'll, going into 2012, she'd have zero equity or stock basis, and she'd have only 2,000 of debt. If that debt got paid off, let's say next year, and nothing else happened, that $8,000 that got paid off, that would generate $6,000 a gain. But again, all it is you're sort of making up for the fact that you took losses against it. Now, in 2012, when you get 9,000 of ordinary business income, now the question is what happens? Well, you restore your basis in your debt first. So she puts $6,000 into her debt, and now it's at 8. And then she puts 3,000 into her stock basis with what's left, so she'd have 3,000. And that's how you kind of work that. A couple of other things to point out that are key. Number one, unlike the partnership, you can be an employee of the S corporation, and many are. Only thing that's subject to self-employment or payroll tax is the salary that you're paid. So there's always pressure placed on these shareholders to make sure the compensation being paid is reasonable. Now, as a practical matter, as long as you have one person that owns stock that's not a shareholder, they usually can police this themselves. Because if you're that person, let's say that you own 10% of the stock and you don't work there and everybody else does, the last thing they're going to want to do is pay themselves a really low salary, because whatever they don't pay themselves that they really earn working will leak through as earnings, and you'll get 10% of it as a non-participating, non-working shareholder. So Generally speaking, there's some pressure there, but there's some mechanisms built in where it kind of gets tempered a bit. Now, this AAA account, all this is this concept. If you're an S corporation and you've never been a C corporation, then all the distributions you make out to your shareholders, the shareholder just has to decide if they have basis, and if they don't have basis in their stock, then it's a cap gain. There's really no other thing that needs to take place. The AAA concept is to track the earnings that occurred while you're an S corp. That's really only necessary if you have been a C corp. So if you've got C corp E&P floating around, okay, and you now start working as an S corporation, the question comes up, well, when I make a distribution, what basket is it coming out of? Is it coming out of the E&P first or the AAA? Because ostensibly the AAA just goes against the shareholder's basis and then cap gain. Again, you can't make that determination. The shareholder has to do it themselves. You make a distribution, they evaluate. If you make a distribution and it comes out of E&P, you tell them, hey, that's a dividend. That's second level of tax from a C corp, and you got to pay tax on it. So again, you can kind of figure that out based on your circumstances. But let's look through this. If you have no E&P, the distributions come out, and the only analytical work is you look at the shareholder. They decide what their basis is. If you exceed it with the distribution, then it's cap gain. If you got E&P, though, the first thing that happens, you take your AAA account, to extend AAA. Then once AAA is exhausted, then you move into your E&P. And for every dollar that comes out of E&P, you tell them, hey, that's dividend income. Then any remaining thing after exhaust of the E&P bucket is just regular distribution. So here's the thing. If you're an outside shareholder, whether it comes out of bucket 1 or 3, you really don't care, honestly. You just need to know how much is coming out of 1 and 3 combined, because that number, you're going to reduce your basis in your stock, and any excess over that where you go down past 0 will be cap gain. As opposed to the E&P, which is going to be just strictly dividends, and you don't reduce your basis for it. It's that second level of tax that never got paid. So it's very critical that these are tracked. Now, again, if you've never been an S corp, it's not necessarily going to matter, but we always track the AAA anyway, because you never know. If you merge with another S corp down the road that has E&P, you might need to know that number. So as a practical matter, we track both, even when you might think it might not be necessary. Okay, couple of other points. Just like C corps, when an S corp makes a distribution of appreciated property, it recognizes it just like it sold it. It does not ever recognize a loss on the distribution of lost property. The shareholder, and when the gains recognized by the company, by the S corp, that flows out like any other gain of the shareholders. Okay, and it says here their stock basis goes up accordingly. All it's just saying is if you're going to treat it like you sold it to the S corp, it's like any other gain. It gets allocated out on a K1. The property distribution, again, is the net fair value if you're distributing debt with it. You have to take that in account and make sure you remember that economically, if I'm giving you something worth 100, but you take debt of 30, it's really worth 70. And then the liquidating distributions, I'd refer you back to the C Corp chapters. It's the exact same rules. So hopefully that helps your jogging your memory with the S corporations and can help you get ready for the exam.